Most traders hear the phrase small loss means big protection, but very few truly understand what it actually means in real trading life. On the surface, it sounds simple. Cut your losses early. But the real meaning goes much deeper than just placing a stop loss on the chart. Small loss does not mean you were weak. It does not mean you were wrong. It means you respected the market more than your ego. The market does not reward stubbornness. It rewards discipline. Imagine this. You enter a trade with a clear plan. You know exactly where your trade idea becomes invalid. That point is not random. That point is where the market tells you your logic no longer works. Taking a small loss at that moment is not failure, it is acceptance of reality. Most traders don't lose money because their strategy is bad. They lose because they refuse to accept a small loss. They wait, they hope, they convince themselves that the market will come back. And while they are waiting, a small, controllable loss quietly turns into a big, emotional disaster. A small loss protects three things: your capital, your confidence, and your mindset. First, capital. Trading is a probability game. You cannot control outcomes, but you can control risk. If you lose small, you stay in the game. One big loss can wipe out weeks or months of disciplined trading. Small losses keep your account alive long enough for probabilities to work in your favor. Second, confidence. Big losses damage your self-belief. After a heavy hit, traders hesitate, overthink, or start revenge trading. But when losses are small, confidence stays stable. You can take the next trade calmly, without fear or desperation. Third, mindset. Small losses train your brain to think professionally. You stop seeing losses as punishment and start seeing them as business expenses. Just like rent or electricity in a business, losses are a cost of operating in the market. Here's the hard truth. Every successful trader has many losing trades. The difference is not the number of losses, but the size of losses. Professionals lose small and often. Amateurs lose big and rarely admit it. Small loss also gives you flexibility. When your risk is limited, you can re-enter the trade if conditions improve. But if you take a big hit, your mind is too disturbed to see new opportunities. You are emotionally locked out of the market. Another important point, small loss is the decision made before the trade, not after. If you decide your stop loss after price moves against you, that is not risk management, that is emotional adjustment. True small loss comes from planning, not panic. The market doesn't care about your feelings, your money, or your expectations. It only cares about price. When price proves you wrong, the smartest response is to step aside with minimal damage. Remember this. You don't need to win every trade to be profitable. You only need your losses to be smaller than your wins. Small loss creates that balance. Big losses destroy it. So, the real meaning of small loss means big protection is simple but powerful. You are not protecting a single trade. You are protecting your future trades. You are protecting your ability to think clearly. You are protecting your long-term survival in the market. In trading, survival comes before profit, and small losses are the price you pay to stay alive long enough to succeed.